Hey everybody, today we're going to do a little review on our three main financial statements, our income statement, our statement of owner's equity, and our balance sheet. And we're also going to be going over the classified balance sheet this time. So let me share my screen. I can't talk today, so I can show you a picture of these as we talk about them. There we go. Okay, so remember this is our income statement. In this example, we're doing an income statement for the 2 months ended December 31st. So that would be November and December. Our income statement, we haven't had any changes to since chapter 1. We are taking our revenues minus our expenses. So we list out all of our revenues, add them up, and we get a total of $16,960. We list out all of our expenses, and we get total expenses of $9,855. Our income statement, as always, is revenues minus expenses. So $16,960 minus $98.55 gives me $7,105. And we call that what? Net income. Net income is our accounting word for profit. If we ever have one where our expenses are greater than our revenue, then we would call this net loss. Because we didn't have a profit, we had a loss. Okay. So, like I said, no changes here since we first talked about financial statements in chapter 1. I do want to remind you, when we are doing our financial statements, these columns are not debits and credits. Notice you don't see the word debit and credit up here above them. They're just columns. They are just there to kind of organize our numbers and make our financial statements look prettier. Okay, so not a big deal, not debits and credits, just columns. Now, remember, our answer from our income statement, net income or net loss, goes to our statement of owner's equity. So I've got this arrow drawn down here for you. That's why we always do them in this order. So you'll see from the income statement, got our arrow down here, $7,105. That net income becomes part of our statement of owner's equity. So once again, for the 2 months ended December 31st, our basic template for our statement of owner's equity has not changed. So if you need review on what we're doing on the financial statements, I have a video in the chapter 1 module in Canvas, and I have some typed out notes with our templates in the chapter 1 module in Canvas. So go back and look at those. We're still saying beginning capital plus any investments plus net income minus withdrawals gives me ending capital. And just make sure we understand, anytime you see this, you could see the word less in front of it, less withdrawals. Less just means we're subtracting, minus. So this is Net Solutions, our example company. And if you remember, at the beginning of November, it was a brand new company. Therefore, we have this beginning capital of 0. Then the owner made an investment. That's a positive. We had our net income for the 2 months. That's a positive. And remember, that came from our income statement. And then during the 2 months, the owner withdrew $4,000. If we do the math, 25 plus 7,105 minus 4,000, we get an overall increase of 28,105. Since beginning capital was 0, 0 plus 28,105 gives me ending capital of 28,105. Don't forget, you have to have the owner's name and a date for beginning capital. and the owner's name and a date for ending capital. If it's for 2 months ended December 31st, when did it start? That's right, November the 1st. And the ending date and the date in the heading will always be the same, December 31st in this case. Now we did our income statement, and now we did our statement of owner's equity. The answer from our statement of owner's equity, our ending capital, goes to our balance sheet. That's why we always do our statements in this order. So here's our balance sheet. Don't forget, our balance sheet in the heading just has the date, the ending date. It doesn't have for the month ended or for the year ended, because it's not a summary. It is simply our account balances at this given date. So our basic accounting equation, our basic balance sheet still has not changed. It is still the accounting equation. Assets equal liabilities plus equity. So notice I still have 2 sections, and those 2 sections still equal. A classified balance sheet just means that I'm going to classify my assets and my liabilities according to time. I'm going to have my current assets and my long-term assets. I'm going to have current liabilities and long-term liabilities. Current, excuse me, whether we're talking about assets or liabilities, current means it's going to be used up or paid off typically within 1 year. Long-term, longer than that, okay? And you'll see companies in the real world use different headings, different titles, but those are your 2 basic categories, current and long-term. Now, as far as assets, we usually call our long-term assets, the assets we expect to last for more than 1 accounting period, we normally call those property, plant, and equipment. Another common heading title is fixed assets. Fixed as in permanent, okay? So look here on this example, we have assets, then we have current assets, and then we have property, plant, and equipment. Current assets, cash, accounts receivable, supplies, prepaid insurance, things that we're going to typically use up within a year. Property, plant, and equipment, things that are going to last a long time, multiple accounting periods, land, building, tractor, truck, furniture, computer equipment, okay? Some of those are going to be depreciated. Remember back in chapter 3, we learned our adjusting entries and we learned about depreciating our, quote, fixed assets, our property, plant, and equipment. In this example, we only have one that we're depreciating, office equipment. So notice now I've got 3 columns that I can put my numbers in. Once again, don't forget, columns are not debits and credits on your financial statements, just columns. So notice on office equipment, it has a balance of $1,800, and then I say less accumulated depreciation. Think back to chapter 3 when we learned about depreciation. Accumulated depreciation we learned was a contra asset. What does contra mean? The opposite, that's right. So it's an asset, but it has the opposite balance, which means it deducts from a normal asset because a credit would deduct from a debit. So office equipment, $1,800. That's how much office equipment I had when I bought it. Now I have depreciated, or remember, used up $50 worth of my office equipment. So I'm going to subtract it to get what we called our book value, how much equipment I have left to use. So 1,800 minus 50 gives me 1,750. This 1,750 is called our book value, And that is what we add up with our other assets to get total assets. So I added these up and I got a little total for current assets and I got a total for property, plant, and equipment. Added them up and that gave me total assets of $29,495. It doesn't matter which column you put these numbers in. So please don't get hung up on that and make it harder than it should be. If you're doing the math correctly, you're going to still get $29,495. And don't get super stressed out about, oh my gosh, what goes in current assets, what goes in property, plant, and equipment. You can see these are pretty obvious. We're not going to get into ones that are going to be difficult at this point. Okay, so don't let that stress you out. Then, under liabilities, we have just current ones in this example. If we had long-term liabilities, which we just haven't talked about yet, then we would have another section under liabilities. Capital. Just like before from chapter 1, we will always only have one number under capital, and that is our answer, our ending capital from our statement of owner's equity. So that 28,105. So assets, 29,495. Liabilities plus equity equals 29,495. So this has just been a little review on your financial statements with a little more explanation about a classified balance sheet. But 99% of our financials are exactly the way that we learned them in chapter 1. So you've got those resources and now you have this. Just let me know if you have any questions. Remember, financial statements are one of the most important outputs of our accounting process. So we want to really make sure we know how to do these and understand what information they are giving us. Thanks for watching. I will see you soon.